All right, Christian, welcome to Living Off Rentals. Welcome back, I should say.
Yeah, no, thank you. I'm so excited to be here. Excited to catch up and see what's going on in our lives and share stories, man. This is exciting. Thanks for having me back.
Yeah, I'm super excited to have you back. Last time you joined me on the show, we were talking about one specific deal you were doing. We were talking about a lot of things that you were doing, but there's one specific deal that you were doing. And I love hearing, it was one that you had just purchased recently. So I love hearing projections on properties. Obviously, as real estate investors, we live in the projection world, always making projections on how properties will perform. But it's one thing to provide projections, and it's another thing to actually now go back and do kind of a post-mortem and look at a property, how it's performed. Because the last time you were on here, it was almost 2 years ago. It was July 1st. I was looking back, July 1st, 2020. Yeah. So shortly after COVID had kicked off. And so now 2 years later, kind of seeing how things have performed and how things are going in your business, how your business has grown in general. I'm really excited to see this. I think people will be really interested to hear. So let's dive in. If you could kind of give the listeners, especially people who might not have listened to the first episode, our listenership thankfully has grown over the last couple of years. So if people haven't listened to the first episode, if you could give kind of a short background, and then, we can get into some of the things you've done since the last episode.
Sure. No, thanks for that, Kirby. Again, super excited to be back here. So my name is Christian Catron. I'm the president and CEO of a company called Redeem Investments. We are a real estate investment company that specializes in a couple of different functional areas that we'll get into. Our niche and our core focus is commercial real estate, but we also have an aspect of our business that does involve residential that I can speak to. But yeah, our focus and our team's focus is to find deals that can provide asymmetric returns for our investors. And so whether that's in the residential realm, in the commercial realm, even land development and renewable energy, believe it or not, we'll speak about all those things. So yeah, excited to be here.
Nice. Awesome. Yeah. And Christian's a fellow West Pointer and previous Army officer as well. So, all right. So when, like I mentioned, when this was released 2 years ago, just to kind of paint a picture for people, this was, we actually, it was released July 1st, but we had done the interview prior to that. So it was very shortly after COVID had kicked off. At the time, we were in the thick of it, everyone was kind of like clueless where the market was going or what was going to happen. Everything was still, obviously locked down at the time. So you were kind of taking a leap of faith. It was a big leap of faith just to be investing at that time. And, you since then, I think have had, it's worked out in your favor. It sounds like. So what's been, I guess, can you talk through your mindset at that time 2 years ago, what you were thinking would happen with the market and why you were convinced that it was still smart to invest at the time? And then what's been your primary focus since that time?
Yeah, I wish I could say that I had a crystal ball to look into and say with absolute certainty that we were going to produce the results that we have, and really didn't have that. I still don't have that. If you've got it, please let me borrow it.
No problem.
But I think what we've seen is that historically over the course of time, real estate has continued to appreciate in value. There are various points of the cycle where you really have to know what you're doing and partner with people who know even more than you do, and to be watchful of how to go about doing deals and especially structuring deals. I think that's really the essence of what I would say is that even in markets where you've got an interest rate, a rising interest rate environment, there are ways to structure deals such that you can lower your cost of capital and that you can remain safe throughout that project. And I'll speak to one such deal that we've got when I talk about things that are coming soon for us. And a seller financing option, even on a commercial asset that we're looking at. So I think for us, we had just come off of buying 3 commercial properties within a 9-month stretch. And this property that you're speaking of was the last one that we had bought in 2019 and had closed in November 5th, in fact, of 2019. So the first couple months of any project is really just understanding what is it that we actually bought and getting an understanding of the tenant base, and then getting started on the renovation work and making sure that that's a highly efficient process. And I think when we spoke and did our interview, we were probably about 75 to 80% complete with the renovations. You may or may not recall, but when we got that property under contract, rents were at $750 for 28 out of the 44 units that had not been renovated. We knew, because the other 16 in the property already were renting at $1,350, that there was in-place rent growth that we could capture by simply doing the renovations. And we did, in fact, do that and more over the course of time. Since the time that you and I spoke, we just continued to stabilize the property, continued to try and get market rate rents, and then at some point decided, I can't recall exactly when, that it might be prudent, given its location and its proximity to major attractions in Arlington, such as Cowboy Stadium and Globe Life Stadium, that we ought to look at effectively transitioning to 100% short-term rental property. And so that's the process that we began.
Nice. Yeah, that's a good overview. Just to kind of recap for people who didn't hear the first interview. So the property that we're talking about that I kind of want to dissect today, just to show people what's possible with a great multifamily deal. So you bought this, you had just recently purchased this property in Arlington, Texas, like you mentioned, right across from Dallas Cowboys Stadium. You purchased it for $3.8 million. The bank, I think, had given you 75% of that, correct? The purchase price?
We actually got a bridge loan at 80% of the purchase plus 100% of the construction cost.
Wow. That's great. Awesome. Yeah. And you said at the time that you were expecting about $1 million of rehab to go into this 44 unit. Was that what it was?
That's right. Yeah.
44 unit. Yeah. Okay. So 8 of them prior, before you had purchased it, had been renovated, and the rents had gone from $700 to $1,300, a massive leap on these renovations. And then 28 of them were at $750, but then the old landlord had raised the rent to $850 prior to you even buying, which added $500,000 of value before you even closed on the purchase of the property, which is absolutely incredible. Because for people who are unfamiliar with multifamily, the value of the property is based on how much income compared to your expenses you're bringing in, your NOI. So you renovated 10 of them at the time that we talked, and you had raised the rent to $1,350 on those 10. And then you're talking about other value add, like bringing internet into the building and doing a cost share on that. You had a great property manager you mentioned. And so you were expecting at the time the value of the property when you refinanced it to be $6.8 million. So to go from 3.8 purchase price to 6.8 million. And that was based off just long-term rents at the time. You hadn't even talked about Airbnb. So I guess, when did your mind start shifting to see that if you incorporated short-term rentals into this project, you had a lot higher revenue potential?
Yeah, I think we tested the waters after the renovation was complete to see, okay, first of all, how many can we in fact convert to a short-term rental? How do we go about doing it? I'm not an STR operator myself. My focus is on acquiring the properties and maximizing value for our investors, and really didn't want to acquire the skill set necessary, because I think it is a different skill set to run short-term rentals. And so what we decided to do is to partner with Airbnb operators effectively who are doing the arbitrage model, and we signed long-term leases with them in the same way that we signed long-term leases with standard tenants. However, given the income that we knew that they could generate, we charged a premium. And so initially we started charging about a 20% premium over the market rate rent, which at the time was $1,350. We charged them $1,850, so it's probably more like 30+%. And then over the course of time, as we got more familiar with the property, understood what it cost to operate that property, we saw an opportunity to increase the amount of, to add an additional component on top of that base rent of $1,850 to help offset the cost of the operating expenses. And so What we have structured now with the short-term rental operators that we have is, in addition to the base rent of $1,850, there's actually a what's called a triple net component, very similar to office and retail and other asset classes within commercial real estate. There's an additional rent amount of $555. And then on top of that, there's an additional amount of $57 to cover what's called CAM, so common area maintenance. So in total, the rent for our short-term rental operators is $2,462 per month.
That's insane.
Which is vastly different than $750 when we first got the property under contract. So what that means is, and from a valuation standpoint, I'll share this, Kirby. You mentioned, yes, our target was 6.8 as a standard market rate apartment at the time, and in December, when we were considering refinancing the property, we received an appraisal for 7.8, which we were ecstatic about. And then since then, based on cap rate compression, in part the conversion of the property, but then also, this is nuts to me, how much, and this is a byproduct of really how rents have increased across the board, but especially in submarkets like Arlington. The market rate rent there in that submarket is no longer $1,350, $1,450. It's actually $1,850, which is nuts for long-term tenants. And what that means for us is that even if someone bought our building now, we received actually multiple BOVs, brokers' opinion of values, from commercial real estate brokers that indicated that the strike price for our property was anywhere between $9.5 to $10 million. And so that was exciting for us to hear, of course. And what that means for our investors, really, which is the most important thing for me, is that our investors, in half the time that we expected to produce a 2.1 multiple of their investment, we're producing a 2.5 multiple of their investment in half the time. So a little bit over half the time. So not quite 2.5, a little bit over 2.5 years. We expected in 5 years to produce 2.1. And so for our investors who invested $100,000, for example, which there were multiple that did that, we're returning to them $250,000 when we close on the property. So that's very exciting. My own mom was one of our investors, and I'm excited to hand her back a check and say, thanks for investing. We've got another one,
Nice. Thanksgiving's going to be better this year. Make an extra big turkey.
I'd like to think so. That's our timing. If timing works out, that's when we'll be able to distribute to our investors. So very, very exciting. I mean, yeah.
I'm sorry. Will they still have equity in the property then, or is that you're buying out their equity?
Well, in that case, we're actually fully selling the property at this point. No longer refinancing. Mm-hmm. And so we're fully selling the asset, and at that point, they'll liquidate their position. Yeah.
Wow. Yeah. And have they gotten distributions throughout?
Because the short answer is no. Preferably they would have, but because of COVID and managing through sort of the whole rent relief thing, it was very difficult to maintain distributions throughout that period. What we're banking on really now is just simply the increased value. And so, again, that equity multiple that I named is even far superior than what we had projected, even inclusive of what distributions we would have provided, if that makes sense.
Yeah. That's amazing. So you hear all these people online, talking about inflation right now and how, big of a problem it is and how costs are going up. And people don't know what to do, to guard against inflation. And I think a lot of people hear that real estate's a good place to hedge against inflation, and they don't understand how that works. And this is such a perfect example of that, because as the cost of everything goes up, it trickles down into everything. Like you can't raise the cost on one thing without impacting others. And so obviously rents are going to go up. The cost of living is going to go up. And so if you own an asset, then you're absorbing that cost. It's increasing the value of that asset because it's based on how much income it brings in. So as the rents go up, obviously the asset's going to be worth a lot more. So it's hedging you against inflation. And then the rate on your financing is still fixed. It's still staying the same. So you're paying that down quicker than you would have had inflation not occurred. So I think this is such a great example. Can you kind of share a little bit more about, you kind of went through the valuation aspect pretty quickly. And I think for people who might be newer to multifamily investing, they don't necessarily understand what you meant by cap rate compression and how, I mean, how, if you could just kind of break it down in layman's terms, how basically why somebody would pay 10 million for this asset right now compared to when you bought it for 3.8.
Yeah. I think what might be helpful if you and I sort of do a quick little calculator exercise to help walk people through that they might be able to do on their own. So let's say you mentioned, in fact, one of the strategies that we deployed at this property, which was we implemented a cable and internet package, right? So our cost for doing that was $55 per unit, and we turned around and sold it to our tenants for $110 per unit. Okay. So our margin on that is $55. So let's take $55 on our calculator. Let's multiply that by the number of units that we had there, which was 44. That's $2,420. If we multiply that over the course of a year, that's 12 months. That's $29,000 of additional income that we didn't have before. The question is, well, what is that worth in terms of value from having generated an additional $29,000? Well, in each market across the country and really anywhere, there's a factor used called a cap rate, capitalization rate, that helps you determine what the value is. And so in this specific market, a very conservative cap rate at this point is 5%. Some would argue it's actually below 4%, and some are right at 3%. But just to be conservative, let's say 5%. So that means we divide $29,040 by 0.05. And what that means is $500,000, so $580,000. If we use the actual cap rate, which is more like 4%, it would be much higher than that. So the point being that as you generate additional income and increase rent, the value of the property naturally rises in order to reflect that increased income.
That's awesome. That makes it so simple for people to understand. And this is how wealth is built. So, you talked about, okay, I set it up for $55 and I'm selling it for $110. And people are like, okay, cool. An extra $55 a month. That's not like gonna change my life a whole lot. But then you multiply it by 44 because it's in a multifamily property. And now, it's an extra $3,000 a month. That's nice. I mean, extra cash flow, but again, probably not like massively life-changing. But then you look at the value that it creates when you go to sell it. And now you've got so much more $500,000 of equity in your property, in addition to that cash flow in the meantime, the extra cash flow that's coming in. And that is really, truly how wealth is built. I think this is such a great, shining kind of a microscope on one aspect. And you can do that in multiple different ways. Obviously, we talked about rent rate. If this is based off $55 of increased cash flow, you went from $750 to $1,850 or $2,200 once you factor in the triple net and the cams. That's a massive increase. Right. So can you also, I think you mentioned Airbnb arbitrage. You kind of mentioned why you're using that strategy, because you didn't want to necessarily be the Airbnb operator, but you wanted to bring in Airbnb operators. So can you kind of explain that model for people who might not totally understand it?
Sure. So Airbnb arbitrage effectively involves folks who want to get in the short-term rental space or are in their short-term rental space, who may either not have the capital or prefer not to own the asset, in which case they simply will approach landlords, whether they're homeowners of single-family homes or apartment buildings, and ask to lease that space, hopefully being forthright with what they intend to do with the space, and get agreement from the landlord, and they're allowed to then operate it as a short-term rental and effectively be the host for that unit and run it as if they owned it. But that's a simplified explanation of what that is. And I call it arbitrage simply because you can lease the property, or you can lease an apartment for $1,000, for example, and yet make $3,000 to $4,000 on that unit, depending on how well of an operator, how good of an operator you are. So that's where the arbitrage play comes in. From the landlord standpoint, I'm highly satisfied in this scenario that I just presented. I may be highly satisfied with a $1,000 rent, knowing that my total expense per unit might only be $500 or $600. Well, for me, that's an extra $400 per month that I wasn't getting before, and yet now it's a consistent income from someone who I doubt is going to want to leave anytime soon. You would hope that the repair and maintenance expense is significantly less, and in fact, I would argue that that's a responsibility of that Airbnb arbitrage operator. Again, it costs a significant amount to turn over units for standard tenants, oftentimes, and can become very costly. And so, having a long-term, tenant per se, who's operating that as a short-term rental presents a lot of value for us. It also helps us limit and minimize the amount of vacancy in an apartment, which is, aside from taxes, could be one of your largest expenses that's reflected in the income section of your income statement. So yeah, for us, it makes a lot of sense to do that. There are limitations from a lending standpoint that we have to be aware of as well and abide by. So yeah, I think it's an exciting approach.
Yeah. I mean, it's such a win-win if you can find win-win scenarios. And I'm obviously a huge advocate for short-term rentals. I help people get their first short-term rental. I walk them through that process in a program that I have, and that's how we've been able to become financially independent, and live off rentals. But I think because of the opportunity that exists in short-term rentals, you can set up these win-win scenarios where, like you said, you're getting more income on your units than you ever expected. Plus, somebody else comes in and is very incentivized to operate those units really well because they're keeping that spread. They owe you the rent that they agreed to no matter what. So anything above and beyond that is money in their pocket. So they're going to want to, do a really good job and operate that really well, which probably means your units are going to stay in better condition. They're going to clean them constantly. Like there's a lot of benefits to having short-term rentals. I'm curious, when you're looking at refinancing or selling now, are the banks or the buyers recognizing short-term rental income when they're running their numbers on what the property is worth, or are they underwriting it based on the long-term rents?
Yeah, that's the right question. That's a great question. And so, what my understanding of how it's being done now, and I know from us attempting to acquire properties that function more like a hospitality project, which effectively these are, that what they do is that they apply a different cap rate to account for the higher risk. And so most hospitality, for example, will trade for 300 basis points above the market cap rate. So in this case, if 5% is in fact what it would be for a standard market rate apartment, then a financial underwriter, financial institution may very well use 8% as the cap rate. And so that what that does is that it does significantly reduce what the price and what the value is. But that's the correct thing to do when you're looking at this as a hospitality play. Now, I think it's much more applicable for true hospitality type of assets like hotels. I think this one has a little bit of a variation in that these are long-term leases that are signed with operators that are incentivized to stay. And in many cases, I would think that, as we talked about, turnover, would actually be less than a standard tenant. You can account in the apartment world, specifically regarding Class B and Class C assets, that you're going to experience anywhere to 50 to 70% turnover annually. And so if you can retain tenants, that's sort of the name of the game. And if they're able to absorb what's happening now with rent increases and everything else, then you're even better off. So again, I just say that within this context of answering the question about financing, that if we were talking about hospitality and hotels where you don't know truly what your occupancy is going to be and what your average daily rate might be, depending on demand and other things, then yeah, I mean, that 8% or that 300 basis points above the market cap for a standard market rate apartment is in fact what you want to do. I think in this case, there's probably some adjustments that are warranted, simply because, again, these function as a hybrid between the two.
Yeah, it's such a new space that it's a little bit like the Wild West. Like it kind of depends on who you ask, and which lender you're talking to and which buyer. Because for me, if I'm looking at it as a short-term rental operator, I'm thinking, okay, if I buy this thing from Christian, he's not operating the short-term rental piece of it, so he's renting it out at say $2,200 to a short-term rental operator. I know that means they're turning around and putting it on Airbnb and probably bringing in $3,000 to $4,500 per month each unit. So that's an extra, say, $2,000 per unit of cash flow that there's potential. So if you went to sell it to a short-term rental operator, that's massive value. I mean, that's above and beyond. That's all profit. That's not, there's no increased. I mean, there'll be some, I guess, increased expenses for furnishings and stuff like that, but pretty minimal. You've already paid the mortgage. You've already, so that's. I think you're creating a ton of value.
Well, that's such a great point. I don't think I consider that even until you said it just now, because I'm only thinking about the income that I'm seeing that's coming into us. I'm not thinking about, or I wasn't thinking about, the income that's actually being produced by the STR operator. So if you actually fully owned this asset and you ran it like that, you could argue that it's even more valuable because of the higher level of income it's producing. Now, that's when it gets a little bit more tricky, and probably, that 300 basis spread comes into play, because now you're truly operating it as hospitality, and you're accounting for occupancy and vacancy and those types of things. But from my standpoint, if I'm the owner of the asset and I'm simply doing the arbitrage model and getting my rent effectively no matter what, then our bases are pretty well covered.
And did your property management cost go way down when you started doing this, because they're not really managing tenants anymore? They're signing long-term leases with property managers, essentially.
So what we did is we didn't renegotiate with our property management company to effectively put a ceiling on their management fee at a fixed dollar amount, as opposed to the percentage that they were getting before, and how much that would have been. I mean, it would have been significantly above what you would pay someone from a market standpoint. So they were amenable to that, knowing that the amount of work once it's stabilized was going to be far less than what they were doing before.
Yeah, especially with CAMs and triple net lease in there too. That's awesome. So, were there any roadblocks or lessons learned or things that came up that were unexpected on this project as you were working through it?
Yeah, well, actually, we're living through some of that right now. Full disclosure. I mean, I think not like anything else, not every short-term rental operator is of the highest caliber, and so you really have to vet them so that you can ensure that they have run their numbers, that they are operating it in a way. Or that they would operate it in a way that ensures their success, because the last thing you want is, your rent to them to be a significant burden if they're not able to produce the type of income that's required in order for them to sustain that unit, right? And so, getting an understanding of how they would how they would evaluate and analyze the amount of income potential and things like that, and account for their costs and things, is very, very important. So I think that's one piece. I think, also ensuring that there's diversification across the apartment building amongst multiple investors or operators is something to consider in order to minimize our risk. I think the challenge with that is the larger the asset is, the higher the likelihood that they would be, competing amongst each other. And so what I'm finding, and really the model that we're moving towards, is that and it's fascinating to me coming across different thought leaders within this space that have a significant following, and how they've created really SOPs and certain philosophies that help ensure success amongst their followers, such that if there's a partnership we can establish with that thought leader who can then influence the success of other folks that now are in the building, then we have a higher likelihood of success as a team in terms of what we're doing from an ownership standpoint, and from what they're doing individually, and working in concert with each other actually to help maximize and really optimize their success. So yeah, those are some things that we've taken away so far. We're making adjustments really now on the fly in order to ensure success and ensure a successful exit for us.
Yeah, that's a great point you bring up, because what most long-term rental investors talk about, especially multifamily, is your success really hinges on finding a really great property manager. And so in this case, you're really finding, really 44 different property managers for the 44 individual units that you've got to work with. Obviously, probably many of the operators have multiple properties or multiple units, but that's a lot more to manage from your standpoint in terms of just managing the manager than it is just one property manager who's managing the whole building. So
yeah, and to clarify, we still have a property management company that we have on site who's doing a lot of that engagement on our behalf. But each of those different operators are the ones engaging with our property manager, and so some of them do have a more robust business model where they've got, an operations person perhaps who's engaging with our property management company. But all in all, I think this has just been a great path for us to pursue, and one that I think anybody who ends up acquiring that building is going to be very satisfied with.
That's awesome. So I think every person listening to this would love to go back in time over the last decade, pretty much at any point over the last decade, and buy as many multifamily properties as they possibly can, knowing what we know now. Hindsight's always 2020, but just because an asset class has done amazing over the last decade doesn't necessarily mean that it's going to in the next decade. You hear people say, well, the stock market's going up, which really what that means is the stock market has gone up. Today is a brand new day. And unless, like we talked about, you have a crystal ball, you don't know if it's going up, that it has gone up. So thinking from that standpoint, are you still bullish on the next decade based on where we're at in the cycle and where interest rates are and all that? And how are you approaching investing in multifamily going forward?
What I would say is that anybody who's not applying a level of discipline to their underwriting process at this point in time is not going to succeed. And what I mean by that is, just as an example, we came in best and final for a 187 unit apartment building in Dallas that we were pursuing. In fact, in Arlington, near our property here that Nice. We've been discussing. And ultimately, after we got to that stage and firmed up loan quotes from our mortgage broker, we went back and sharpened our pencil and even included the cost of a rate cap, simply to say, hey, if we have a bridge loan, again, like we used before, that even though there might be a floating rate for a period of time, that it cannot exceed a certain amount. Well, that costs money. That's $500,000 or more potentially to simply buy a 2% rate cap.
Wow.
What we're seeing some operators do is that they are buying the rate cap, but they're not accounting for the increase in interest rates in year 2, and then yet again in year 3. Whereas we are, because if we're expecting that to occur, at least to get to the cap, then we need to account for that. And you'll see what that means in terms of, okay, does that mean that we're still able to service the debt with the income that the property is producing? Is this still self-sustaining? And do we still meet the debt coverage ratio requirements that the lender has for us, right? The other thing that we do is when we, even though 4% cap rate might seem pretty aggressive, that's really what things are trading at. We'll buy something at what it might take to buy it at whatever that cap rate might be, assuming that upside is available. But we're still going to be wise about our reversion cap rate, meaning what cap rate are we going to use to ultimately apply to what our net operating income is at the time of exit. So if we're buying it for 4%, it certainly shouldn't be less than that, but it may very well be in our model 5.25% because we're being conservative in what our exit valuation would be, right? So I think if people have your left and right limits and have your guardrails set, I don't think you should stop buying. I think you have to be disciplined, and I think you have to be wise and selective. But with the thing that sort of counterbalances all of this is inflation. Interestingly, inflation specifically with regards to rents, because rents continue to increase, then the value of the properties will continue to increase. You have to make sure that your financing terms are fully accounted for as you underwrite these assets. So the other piece that I'll speak to on that note is how else are you thinking about lowering? Because ultimately that's what we're talking about when we're talking about financing terms and things.
You cut out there for a second. I'm sorry. Lowering what?
Your cost of capital, right? And so oftentimes what we're speaking about now is our interest rates and how that would affect your desire to want to continue pursuing acquisition of multifamily assets. Well, if you can get a portion of the property to be seller financed or to be held as a form of retained equity by the seller, for which you either pay $0 during the hold period or a smaller amount than you would have had to pay if you got that component financed, then your total cost of capital is less. So as an example, there's a property that we are pursuing now. The seller wants $12.75 million. I think we're going to land at 12. But there's also an opportunity for them to finance or to carry rather 25%. And I say carry as opposed to finance because it wouldn't be a second mortgage. So they would carry, in other words, they would retain ownership for 25%. Well, that significantly lowers the cost of capital because now we're only paying interest on the 75% that we're financing, right? As opposed to the entirety of that amount. And or actually, let me add this. You might ask, well, where would that money come from otherwise if not the seller? Well, typically we would have to then raise money from investors. And really, for investors to take the risk from an equity position on a deal like this, they would want to be compensated. And the standard compensation typically is a 15% IRR, a 15% internal rate of return. Well, if I can get that 25% effectively financed for 0%, then that's a whole lot of money I'm not having to pay to a group of investors because this owner, this seller is willing to hold on to that as we increase the value of the property. And then once we exit, we can pay them the remaining amount.
Yeah.
So those are, and these are sort of standard creative financing structures that happen all the time in the residential world. But I guess I'm just here to say that it can happen also in the commercial world.
Yeah, man, there's a lot that went into what you're just explaining. And some of it might've gone over the head of some who are newer, which is fine. Like this is the right conversations you need to be listening to or thinking through if you're interested in getting into multifamily, because there's different components to consider and different levers that impact other aspects. But just what you said about the owner finance, I think one question might be that people have is, well, why wouldn't that owner want the 15% that an investor would? And I think it's important to recognize the motivation of different people who might be involved in the deal. And so he's already in the deal. He's trying to sell it. He's already created a ton of value for himself. And so if he can create a little bit more by owner financing this property, that's really valuable to him as opposed to somebody who's not in the deal and they're coming in fresh. And so they're going to want a higher rate of return on that same piece of the pie that you're basically financing one way or the other. So that's really
let
interesting.
me add that's perfect, Kirby. Let me add two pieces to that. One is, oftentimes if a seller wants a certain price, then we'll say, okay, we can meet your price if you meet our terms, right? And so really on this deal, 10 million was the max that I was willing to offer. But the fact that they're willing to finance the property, finance a portion of the property, and we've started discussing something else that's sort of a creative approach that we have fielded in other deals, which is, hey, your roof is pretty jacked up and it needs to be replaced. And by the way, we have hail damage reports that indicate that you can qualify to file a claim. And so if you do that and you use our preferred public adjuster to file that claim on your behalf, you can assign those proceeds to us, and we can structure that as part of the deal. And in that case, we're willing to pay you the price that you like, right? The other piece that I'll say is that when I was talking with the owners, we're touring the building, he said, and we started talking about price, in his Texas twang, he basically said, well, I'd love for you to pay me as much as I'd love you to pay me as much as possible, but I don't want it all up front. And the reason he said that is because I broached the topic of tax liability and ways that we can structure the deal in order to help minimize their tax burden. Because if you imagine, if we're buying this for 12 and they only have a loan for $1 million or $2 million, that's a $10 million gain that they're going to have to pay taxes on. Well, if they only have to pay taxes on 10 million because they're going to carry 2 million of that, you see what I'm saying? So that it lowers their tax liability by helping structure this phased approach to a sale.
Yeah. Because you're paying taxes on the overall, your tax rate goes up the more you make every year. If you can spread that out, you're paying a lower percentage every year too, along with probably accumulating more write-offs each year. So that makes a lot of sense. Those are really creative strategies in this market. And one thing you also mentioned that I think is really smart that I don't know that a lot of people are doing is, underwriting in higher cap rates. And I think a lot of people don't understand that there's no such thing as like a cap rate that's assigned to a property or to a market. It's purely based on supply and demand of, how many people want to buy that asset in that market, because it's really just a rate of return on that particular type of asset. So, we've had this perfect storm of lower interest rates, higher rents, compressed cap rates, lower cap rates that people are willing to use to buy properties. But if things go in the other direction, then they could very well be higher next year or the year after or whatever, based on supply and demand. And if market conditions change, that's something that I think is really smart for people to be doing and considering, because that same asset that you're now paying 4% for probably had an 8% cap rate not too long ago, in the last decade at some point. So that's half that's a pretty big reduction. So that's interesting. So I guess speaking of cap rates and interest rates, do you feel like, the interest rates have gone up a couple percent just in the last several months. So, what's your thought on where that's taking us? And obviously, if that continues, that's going to change the dynamic of supply and demand across the board. And so then that should have an impact on cap rates, I would think. And so what's your thoughts on interest rates?
Well, I think that the Fed might be meeting again today, and there's an expected increase there. So that's the very reason, as I mentioned earlier, that in our underwriting model, we're not simply taking our going in interest rate of 4.6% and assuming that we're going to be able to sustain that during our interest only period of 3 years. We're actually accounting for increasing to 6% in year 2 and then 6.6% in year 3. Simply because that we're fully expecting that to occur. And so that's what I mean by, if you're baking that into your model and you're accounting for that, then and the numbers still pencil out, then you're good.
Yeah.
But if you're not doing that and the deal looks really good and you approach it and you close on it, it's not going to be a good thing.
Yeah. Yeah.
We've got, our mortgage broker, in fact, has advised us to a degree that there's going to be some really good deals that come up in the coming months and years, because there are a number of operators that aren't doing as we're doing, and that are unfortunately going to catch themselves in a situation where they're not going to be performing well on the property. So, but yeah, I think, the topic of interest rates really just comes down to how, I don't know if there's been another time where we can actually fully foresee a rising interest rates. Like, there's no guessing. Like, you don't have to guess whether it's going to go up or down next month or 3 months from now. Like, it's going up. The question is by how much.
Yeah.
And that's why you want to buy a cap rate, or a rate cap, so that way it doesn't exceed above that amount. So again, if those things are being accounted for, I'm still bullish on acquiring the right types of assets. I think this might be a good time to sort of introduce one of the things that we're working on in order to help better navigate this entire environment, and to be able to produce the types of returns for investors that satisfy both ones that are looking for cash flow as well as ones that are looking for value creation, right? And so we're actually, my business partner, who's a class of '02 guy, Michael Uperio, and I attended an investment fund conference this past weekend, where we learned a lot of different things that help to further enhance our knowledge around investment funds. And so we launched a renewable energy fund last year, in fact. And so within the coming year, maybe even sooner than that, we'll be launching a commercial real estate fund focused on growth and income. So the growth being effectively long-term rental properties, the value-add apartment buildings. The challenge with those at this time, in large part because of interest rates, like you asked about, Kirby, is that the cash-on-cash returns are very slim, simply because if you're accounting for the cost of money, the interest rates, adequately, it's producing, even for deals that you can buy for $120,000 per door, and that will sell for $180 to $200 per door. Even those deals in the interim are only producing a low digit cash on cash return, which is not very exciting for any investor, right? Especially for the risk they're taking.
Right.
So the question is, how do you help sort of counterbalance that and help produce a higher cash on cash return? Well, we just got done talking about short-term rentals. And I think you, better than anybody, can actually speak to what kind of fabulous returns those are producing for you. And so why not blend the two within the context of a fund, whereby we're acquiring assets like the one that we're selling now in Arlington. We've got a 32 unit down in Webster, Texas, southeast of Houston, that we're considering doing the same thing, and buying additional smaller size assets that then function like the Arlington property has. We already have proof of concept. And so now scaling that part up, and that produces a higher cash on cash return than does the value add multifamily, except that provides significant upside potential, whereas our short-term rental can provide immediate and cash flow in the interim. So bringing those two together within the context of a fund is what we are actually starting to pursue and head down the road of doing. So very excited to be able to share that with you the next time we come together.
That's awesome. And that is such great forethought into where things are going, and to be able to brace for it. And it's so funny how much the multifamily space mirrors the single family space, because I'm buying single family short-term rentals, or 2 to 4 units, and thinking in terms very similarly. I used to buy long-term rentals that I could create a whole bunch of equity through forced appreciation, through renovation, and cash flow. I wanted the cash flow, but it wasn't as important as now. I'm buying these short-term rentals that cash flow like crazy, in some cases up to 10 times as much as a long-term rental. And so I'm willing to trade a little bit of equity to get into these, because it's such a competitive market. And knowing that you can make up to 10 times as much in cash flow, I'll trade a little bit of that upside in value, even though I know, over time it's still going to improve in value. But it's really interesting to hear how you're thinking through that, and I think that's really smart. If somebody is interested in potentially investing in that fund, what's the best way to find out more?
Yeah, I think you can go to our website, which is redeeminvestments.com. You can also send an email to info@redeeminvestments.com. And so, yeah, I'd love to be able to help answer questions for anybody who might be interested in something like that.
Cool. Last time we talked, it sounded like you were kind of a one person business at the time. You had some younger guys that you're talking about kind of bringing up and teaching how to get into multifamily. But looking at redeeminvestments.com, your website, it looks like your team has grown quite a bit as well. How did that come about over the last couple of years? What does your team look like now? And I guess, how do you recommend people grow their team?
Yeah, no, I mean, that's a great question. I think the first thing is realizing that it is a team effort. I don't think any one individual could do this by themselves. I think you might have heard this. There's an African proverb that says, if you want to go fast, go alone. But if you want to go far, go together. Yeah. And so, we're in this for the long haul. And so I realized that, man, I really need a right-hand man, a thought leader, or a thought partner who's a leader in their own right, shared values, and because of the black and gold, the West Point network, he and I were able to connect, and so he joined us a little over a year ago, and has been instrumental really in the operation of our business and in preparation for scaling. And so he's been a wonderful add for us. Having assistance, whether virtual or otherwise, help take care of some of the ongoing recurring medial tasks that you otherwise would get consumed into doing is really a huge game changer as well. And then, there's somebody who I needed to help engage with our property management company on an ongoing basis, especially as we were stabilizing our assets and managing through rough times, as well as execution of the business plan and things of that nature. And so, Michael really works hand in hand with our asset manager. His name is Nelson. And then we have the folks that you named, the younger West Point grads on our team, who we've taught how to underwrite deals and really have been instrumental in helping identify leads for us and managing through the acquisitions process. And so it really is a team effort to try to go through all of that to manage, acquisitions, operations, administration, all those things. We're building out a bona fide business that we're eager to scale and are prepared to scale at this point.
Nice. That's awesome. What's last question too, by the way? I know we're getting up on time, but what's your goal from here? Where do you want to get to?
Yeah, well, the fund that I mentioned, if things go as planned, would be $100 million fund, and in that fund we would acquire value add apartment buildings that are large in scale, so 150 units or more, and then we would acquire smaller apartment buildings that function under the STR model. And so when you fast forward time, that's really what we would be doing. Interestingly, I also want to remain opportunistic, and I know that we can't do it all and you don't want to lose focus, but the fund will really be a stake in the ground in terms of the platform by which we acquire these assets. But at the same time, we also see things happening in the marketplace that warrant pursuit. So just as an example, I'll leave you with this, and I'll give you more details when we stop recording. But we're buying an office building in Temple, Texas, which is just an hour north of me. And we effectively were approached by a hotel developer who had been eyeing that building for the last 3 years. We happened to get it under contract before they even made it available for sale. In approaching us, they offered to purchase it, which we agreed to. And so we're selling it for a price that I won't name now because we're in process. But more importantly, we're staying on board, and they've invited us to stay on board as a co-GP in order to develop the project. And so we initially were preparing to purchase this asset on our own. We had raised capital to do so. We were going to, reposition that property and really add value to it. And here they came and offered to partner with us to effectively purchase it first, and then to transfer the equity that we had raised into the project, allow our investors to invest in the project while we remained on as a significant co-GP in that project. And so, we're not in the office building space. We know barely anything about office. What we do know is finding good deals, and when we have a good deal, and how to structure them, and then partner with other people who are experts in the space to allow them to do what they do best, and we can sort of ride their coattails and extract value from what we bring to the deal. So we're remaining opportunistic with regards to those types of things, and we come across those, knowing that the office space, due to COVID and due to folks' ability to work from home, that there may not be a mass return to the office environment, but rather there will be, vacant buildings and underutilized buildings that we can come across and repurpose for its higher and better use.
That's great. And even like you mentioned before, there's operators right now who are underwriting deals that they're buying right now extremely tight. And so as market conditions change and the cycle, continues to evolve, there's going to be more opportunities there too. People think, well, I didn't buy in the last decade, so I lost the opportunity to buy. Well, there's going to be a new wave of opportunity coming. It's just going to look different. So I think staying in the game and not just writing it off and saying, well, we're at the end of a really profitable market cycle, so I'm just going to sit on the sidelines. There's always opportunities. They just come in different shapes and sizes. So I love how you've kind of taken the time to sit and think about that and start to evolve the way you're buying to match how the market cycle has changed. I think that makes a lot of sense. So I really appreciate this conversation. It's really interesting. I've learned a lot. I know the community is going to learn a lot when this is released. And so I love how you've evolved over the years. And you've taken the time to sit and think about where we're heading in the market cycle and adapt your investing to in accordance with that. I think a lot of people are like, well, I've just got this one strategy, it doesn't work anymore, so I'm just going to sit on the sidelines and wait for that strategy to work again. And it might never work again. But you always need to be thinking through where we're at, where you think opportunity is. And, you got to have the courage to take action. And that's what you've done. And it's really paid off for you. So I love that.
We certainly haven't arrived, but I really appreciate the sentiment. I mean, there's still a lot of wood to chop and a lot ahead of us. But I'm excited about what the future holds and excited to build a team to help us get there. So again, thanks so much for having me. I really, really appreciate it.
Yeah, no, I appreciate your time, and we'll talk soon.
Okay. Thanks so much.
Awesome.
Bye.